There you go. Perfect.
Hello and welcome back, everybody. Just waiting a little bit so that everybody has some time to jump on before we start talking about Japan. It's going to be an interesting discussion today. We actually have a YouTube video that's currently being posted right now on the topic. So some of you might be joining from the YouTube video. I'm not sure if it's already posted, but this is definitely the topic I think is that could really come into play over the next few months if this setup that we're looking at actually plays out. And I think there's a reasonable chance that it plays out. We're certainly betting on it on the website with our clients. So let's get into it. Let's talk about Japan. This is the US dollar to Japanese yen foreign exchange rate. And you can see this goes back, this is a chart that goes back to the 1970s, right? And if you know anything about technical analysis and how price action works, this is potentially one of the largest bottoming patterns of the US dollar to Japanese yen rate around bottom, right? And so while we were used to seeing generally in the 80s, 90s, early 2000s, 2010s even, you had the Japanese yen generally strengthen against the US dollar. We've generally seen a rounding of that, and we're going to talk about the macro developments that have been responsible for that. Again, we're going to dive into a little bit more detail than we did in the YouTube video. But there's been a reasoning for why this actually is taking place from a macro standpoint, from a fundamental standpoint, and why we're at such a pivotal moment right now, and why we're seeing the right triggers take place that could potentially trigger an outright collapse of the Japanese yen, right? This is the US dollar to Japanese yen exchange rate. And so a breakout above this 40-year resistance tells us that there's no longer enough buyers of Japanese yen to keep the Japanese yen below this level. This is a major development that could happen with, you can see a pocket of air here. It works on the way down. It also works on the way up. You have very little resistance or support in this zone. So it's really, again, there needs to be that trigger. There needs to be that fundamental reasoning for that breakout to take place. But once it does, there's potentially room for very little resistance and very little selling pressure here to take the US dollar to Japanese yen exchange rate much higher, making the yen much weaker. So before we dive into the details of the Japanese yen and how we're thinking about this trade right now that we took at Bravos Research, we need to talk about the US dollar. We need to talk about what our thoughts are on the US dollar as an investment, as an asset, and how it's performing against other parts of the market. So yeah, let's get into it. Nick. I don't know if before we dive into all of this, if you have any thoughts.
I think I'll save some of my comments for when we get into the U.S. dollar a little bit more,
All
uh,
right.
because I think that's a very important place to start. Because when you're dealing with a pair and you're trading, one currency against another, it's not just necessarily a story of one currency. It can be a play on both stories, right? So I think it's important to look at both pictures and paint the full picture.
Yeah, yeah, absolutely, absolutely. So that's what we're gonna dive into here. First, let's talk about gold because when we talk about the U.S. dollar, we often, of course, come back to the Dixie, right? The U.S. dollar index, and we talk about the strength or the weakness in the U.S. dollar index, but that's against a basket of other currencies, of other fiat currencies. When we're talking about the dollar, we're also talking about the dollar strength against other things, right? Against assets, against things like gold, right? That tends to be a place that investors flock to when they're not confident in the U.S. dollar's value, not confident in its ability to um, to to keep generating a return on investment for a holder of the U.S. dollar. And so, one of the things that I think is important to talk about here is uh, the melt up and when precisely the moment where things really started to shift and accelerate on the precious metal front, and this debasement trade that we've been in really started in April, right here on right after Liberation Day. You can see a melt up that started immediately after that. Gold consolidated and then continued to move up very aggressively at a faster pace than anything that we had seen before, although it had already been strong before that. And the same thing, by the way, can be said about silver, right? And I'm perhaps going to take a look at another chart of silver. So we don't have my technical levels, but you can see that the moment where silver began to really go on a melt up was right here, right after that Liberation Day sell-off. The market bottomed, realized that we weren't heading for a deflationary spiral, and that turned into a melt up on silver, right? So that's really where the turning point was, and you can see if we take a look at palladium, palladium um, did something quite similar right here. Let's remove these lines. You can see this April Liberation Day sell-off. You can see mark the very, very bottom of that move on palladium. And since then, that marked the bottom of a absolutely massive downtrend in palladium, and was followed by a huge upside. So precious metals across the board following that April 3rd announcement have been melting up. And again, let's talk about platinum. Um, April 3rd, right here, after having consolidated for months and months, that was the trigger, right? And it's been melting up ever since. Uh, so it's one of the things that we've been talking about here over the last few months, and even before that. The gold trade has been taking place now for multiple years. It really started in late 2022, and those other parts of the precious metal space have really been catching up to what gold has been doing. But we're seeing really an acceleration of what took place before the Liberation Day is generally policies that are aimed towards weakening the dollar, right? Um, Trade policies, fiscal policies, and soon to be potentially monetary policies with the Fed cutting interest rates and potentially bringing interest rates down into negative territory on a inflation adjusted basis. There's also more room for all of this to run and for all of this to continue. And so I think that's one of the things that's important to remember. in regards to what's happening on the US dollar and this Japanese yen. And this has prompted us to have significant exposure in the past to weak US dollar bets, right? That's against the US dollar, like gold, that is inversely correlated to the US dollar, right? When we take a look at the dollar um, against the uh, price of gold, you can see generally when the dollar falls, when the dollar loses its status, you see melt ups in gold, right? When the dollar rises, you see gold fall, and then again and again and again, and you can see that generally take place over time. And if you take a look at, let's take a look at my different screen, and you can take a look at the trades that we've had over the last over the last couple of years, right? And you can see in 2024 we had bets on silver, right? We've had, let me scroll down a little bit more, because it was a little bit more towards the end of 2024 that we were taking advantage and really booking profits on some of the big trades that we had throughout that year. Silver, 41% trade here in 2024 that we booked profits on. GDX, which is the gold mining sector, 22% profit right there. We had some trades on palladium as well, 10% profit there. SLV again, GDX again, palladium again. So the precious metal space is something that we've been taking advantage for throughout 2024 and also throughout 2025. UGL, which is a leveraged bet on gold, 24%, 27%. So Orla Mining, which is a gold mining stock, 17%. So this has been an integral part of our strategy, is betting against the status of the US dollar, not just against other currencies, but just generally the value of the US dollar moving down. And it still remains the case. And I'm going to get to why this is relevant to the Japanese yen in just a second. But it's still the case today that we have currently trades on, if I go to our current trades, you can see that we have trades on the metal mining sector. This is the dashboard, by the way, that we have on our website, where we highlight all of our positions, our weights, and we send alerts for all of these things. But we have exposure to the metal mining sector, which is essentially exposed to downside on the US dollar, on Greek stocks, so foreign stocks, which do well when the US dollar declines. And we have exposure to silver, exposure to copper itself, the metal itself. So lots of different bets here on against the US dollar. And where the Japanese yen might confuse some people is that the Japanese yen is actually a trade on the US dollar, going long on the US dollar. And so I think, this is a key component of actually why we like the Japanese yen, is it is actually a hedge against these bets that we're taking against the US dollar. So I'll pause here very quickly. I don't know if you had some comments on that, Nick, but I'll come back to a chart of the dollar so that you can comment.
Yeah. So like Peter was alluding to, we do have a lot of bets around the whole debasement trade on the US dollar. And I think and I believe this is kind of where he's going, is because we're using the yen as a trade um, essentially against the US dollar. It's it's an interesting hedge, because if we do have strength in the US dollar, um, this trade should play out very well. However, um, the interesting aspect of this trade is because of how weak the yen is and the direction of the Japanese market. Um, that doesn't necessarily need to be the case. And I'll let Peter bring up the chart here, because I think that's kind of along the lines of where we're trying to go with this presentation here.
Right, yeah, absolutely. That's exactly where I was heading. That this has generally been an environment where the dollar has been weakening, right? And a good chunk of this weakening has been again due to generally the dollar losing status, and all of these weak dollar policies that we've talked about. When you take a look at the U.S. dollar against the euro, right, and you take a look at what the chart on the US dollar to euro looks like, we've had a huge breakdown of a secular uptrend of the US dollar against the euro that started in 2008, and really ended in 2022. And we had that breakdown right here on Liberation Day, in April 2025. And this is not a mistake. This happened for a very good reason, because of a deliberate attempt or strategy to weaken the US dollar, to make US goods more competitive, US talent more competitive, which boosts manufacturing, boosts earnings. So there's a whole debate on whether a strong local currency is a good or a bad thing. Certainly, the current administration seems to be more leaning towards they want a weaker exchange rate for the U.S. dollar, and they're getting it, at least relative to the euro. This has nothing to do with any strength in the European currency, the euro, but it has to do with the loss of confidence in the U.S. dollar. And so when we take a look at that chart that I was just showing you earlier, you can see this blue line here is the Dixie, so it's the US dollar index, and it has been weakening again since 2022. It's generally been going down, dragged down by the US dollar to euro exchange rate. But you can see the yen is inching higher, and it's actually diverging away from the US dollar index. And so what's really happening here is, yes, investors, markets are losing a little bit of confidence in the US dollar, and we'll see how much room that has to run. But they're losing even more confidence in the Japanese yen. So despite this decline in the US dollar, the Japanese yen is still able, the US dollar is still able to appreciate relative to the Japanese yen. And so that makes it a very interesting bet, and we're going to dive into that in a little bit more detail in just a second. But that makes it a very interesting bet to go long on the Japanese yen, on the US dollar against the Japanese yen. Sorry, so going short on the Japanese yen, while we have all of these bets essentially going short on the dollar. Gold, copper, silver, all of these things are short on the US dollar, and will thrive if the US dollar continues to decline. But the goal of a hedge, right, is that you don't know what could happen, right? Perhaps these weak US dollar policies will fail because something bad's going to happen in Europe, right? Who knows? And they go through another energy crisis. The war between Russia and Ukraine breaks out to a larger involvement, and that weakens the confidence in the euro, and that creates a lot of strength in the dollar, where investors come back to the dollar. Just a hypothetical scenario that could lead to strength in the dollar that is not related to any of the other factors that we're looking at, for example. In that case, that strength in the dollar could potentially also be enough of a catalyst to lift the US dollar to Japanese yen exchange rate, right? So it's a two-way bet, in the sense that we think it can do the fact that the Japanese currency is very vulnerable, and again, we're going to talk about that, very vulnerable to weakening additionally, despite any more weakness in the US dollar, is a fantastic hedge against the possibility of us being wrong about the US dollar weakening and actually seeing a bounce in the dollar here. So it's a way of hedging, and we talked about this on our video on the NVIDIA short, where it's not essential to have these types of hedge positions, but it does smoothen out your returns. So if you're very, very aggressive on the loss of the status of the US dollar as a reserve asset, and that you're very aggressive on these bets on silver, gold, other precious metals, even foreign stocks, right? If you're very aggressive and exposed to that, you can be right about the direction of those trades, but they're going to be you're going to see some swings, right? You're going to see some periods where the dollar is not weakening, and those bets are actually falling, and you can be whipsawed out of your positions. And if you have other bets that are somewhat uncorrelated to those, and that are actually antagonistic to those bets, but that can still appreciate and still have a great risk reward, which is the case for the Japanese yen trade that we're doing now. That can smoothen out your returns along the way, and that's something that is maybe a little bit higher level in terms of portfolio construction, and it's not necessarily the first thing you need to do as a trader. That's not the first thing that we recommend to people starting out trading on our service. We actually recommend you to generally stay focused on one asset or one particular theme in the market, and really learn to know that inside out, right? So if you're interested in stocks, learn stocks inside out, know how stocks behave, learn the different sectors, learn how they behave around earnings, how you can identify strong momentum, how to trade around gaps, right? So all of those things that you can understand how to build your edge in stocks. And then once you've become profitable, once you've understood and implemented a profitable trading strategy, you can then branch out to other macro assets like precious metals, commodities, crypto, bonds, currencies, all of those other things where you can find other opportunities. And that as you're able to do that, that will widen your horizon to potentially look at different opportunities, right? And you can find, for example, you can have no opinion on the US stock market, but have a strong opinion on where gold is going, and make a very strong return thanks to gold, and not be too involved with the stock market. So it is an additional edge and an additional advantage to be able to understand and participate in other assets. But I wouldn't say that this is something to do when you're a beginner. So before we get into the details of what's happening in Japan, I don't know if you had some comments on this.
Yeah, just to go back to your point about this as a hedge. Um, so a lot of traders, the way that they see they see or they utilize hedges is either hedging their portfolio with cash, so removing their percentage of allocation to the equities or to whatever asset that they're investing in, and that is a form of a hedge. Um, a lot of other traders use direct shorts to their own positions. So if they're, say, long on the market and they're long, say, 70% of their portfolio, they may take a 10% short in that position if they want to go and hedge directly with their own position, um, which may work for some. That's definitely not the way I prefer to approach it with regards to hedging. But this particular way of hedging is creative because not only are you hedging against a lot of the drivers of the positions that our portfolio is currently made up of, but it's a hedge that can still play out in our favor regardless of um, the weakening dollar that we still have. So it kind of plays out both ways, and if we do get
Yeah,
strength return in the dollar, this is a position that should play out very profitably, and if not, the rest of our portfolio should benefit from a weakening dollar.
yeah,
However, this trade could still work out because so far the yen has been more weak than the US dollar. So it's a creative way of approaching a hedge in a less direct manner, which I don't think a lot of newer traders think of. So there are different avenues to go and approach hedging a portfolio.
Yeah. Yeah, absolutely. Absolutely. There's a ton of ways to hedge and different strategies for hedging. But yes, this is definitely one of them. And yes, just seeing the comments here. Um, Alexander saying he's getting chopped up in trading different asset classes. That's definitely a very frequent mistake that a lot of people make starting out, because one of the things that's fascinating and that attracts a lot of people to trading is the fact that you can trade all of these different assets and that you can learn so much stuff about different parts of the market and how the world impacts those different parts of the market. It's fascinating, but ultimately, uh, there's the different markets have very different ways of operating, and the way we found the fastest way to become more profitable in the market is to really get to know one market inside out, learn the ins and outs of that market before you move on to scanning for other opportunities. So I think that's great point for you and other people watching this. So let's dive into Japan and what is actually happening and uh, why there could be a breakout here on the US dollar to Japanese yen ratio from a macro standpoint. Now, again, we'll talk about the trading, and we have a stop loss on this position. So, we're wrong just about as much as we're right. And that's a very important point to know before we get completely lit up by the comment section for maybe the Japanese yen strengthens over the next few weeks, and we'll get stopped out, right? So we have roughly maybe a little more than half of our trades that are successful, and a little bit less than half that are unsuccessful. That's not where our edge is. Our edge is not on being right on the market. Our edge is, and again, we can very quickly take a look at the closed trades that we've had for 2024 and for 2025. Let me go on our landing page right here. You can see, yes, 99 wins and 75 losses. So a little bit more than half are winning trades. That's not where our edge is. Our edge is on the fact that our wins significantly outweigh our losses, right? That our average win is at 16.4%. We generally try and capture large chunks, right? And repeat that as much as we can, right? So it's 16.4% is it's a good, right? It's a good gain. The S&P 500's gain over 2025 or 2024 was roughly, well, I believe it was 30%, but the average S&P 500 gain is 10%. So that's a very strong return that you can do over and over and over and over again. Now you're going to have losses, of course, but if you're able to manage your risk on those, you can be wrong just as much, just as much as you're right, and still grow your capital, grow your profits. So that's before we get into that our specific opinion on the Japanese yen to US dollar. I did want to put that disclaimer on. The fact that we have a stop loss, and that's just part of trading, and we're not going to be right 100% of the time. Nobody is right 100% of the time, and anybody that tells you that they is lying, or they have no idea what they're doing. So let's talk about what's happening here on the 30-year Japanese bond yield. This is the longer duration bond yield in Japan, and it's currently hitting 3.09%. Well, it hit 3.4%, which is the highest level, at least on this chart, going back, I believe, to the 1990s. So what does bond yield spike mean? It means that investors are looking for higher compensation to be a holder of that bond. So they're not as confident in holding that bond. And you can see it's a complete surge. So it's a panic out of the Japanese bond market as we're seeing that. And we know exactly what's driving this, right? We know that first of all, there's inflation in Japan, and we talked about this in the YouTube video that we posted today. And there's also QT, right? And you can put Japanese central bank balance sheet on top of this, and you can see while the Japanese central bank was generally buying Japanese bonds in the 2000s, 2010s, and that was keeping a lid on Japanese bond yields, because when you're buying bonds, right, that's creating artificial demand for those bonds. And now they've stopped buying those bonds, and they've even sold some of those bonds more recently. And that's creating a panic in the Japanese bond market because, well, you're realizing that the largest buyer, the largest holder of these bonds has turned into a seller. And so there's that support of the Japanese bond market that's gone, right? And so that's what's creating this spike in the Japanese interest rates. But what's fascinating is that this is only happening really mainly at the long end. The long end is at 3.4%. And when you look at the Japanese, you look at the Japanese central bank interest rate, which is the short end, right? It's the part of the curve that they control with just like the U.S. central bank, they control the rate, right? That's at 0.5%, right? And the reason for that is that the Japanese central bank absolutely does not want to see higher interest rates. Yes, they want to control inflation, which is why they've been doing QT and they've been tightening liquidity to control inflation, because that's a danger to the bond market. But they don't want higher interest rates, and the reason for that is, again, we talked about this in the YouTube video. They have massive amounts of debt. This is the developed economy with the most amount of debt. And so if they let their interest rates run too high, and it's currently ramping up to quite high levels, and it's we're seeing somewhat of the same thing on the 10-year Japanese 10-year Japanese interest rate. That's also spiking. Let's put this on the same scale. Not quite at 4%, but it is very rapidly catching up. So there is this big bond market panic that's taking place on the long end, but the central bank is not at all in a position to really raise interest rates, because doing so will put so much weight on government spending, right? Keep in mind, the Japanese government spends roughly 25% of its budget to servicing the debt, right? If interest rates spike to 2%, 4%, that's going to start to become a larger and larger chunk and really squeeze government spending in Japan. So it's not something that they want to see. In fact, the Japanese government has already talked about tapering the selling of bonds, right? So they're talking about the end of QT already. Let's put the Japanese central bank assets, right? So this selling of Japanese bonds they've been doing here over the last year to try and control inflation, they're already talking about stopping that. And at the same time, they have the Japanese government that's approving new stimulus, right? They just went ahead with a new stimulus package that's going to be fueling inflation. So you have this combo of essentially the central bank needing to stop selling bonds because bond yields are spiking to crazy levels, and the fiscal policy in Japan being inflationary. So they're going to try and cap bond yields. And what happens when you cap bond yields? Well, you have a loss of confidence in the currency, right? And so that's how a debt crisis takes place. And that's potentially what's taking place. And depending on how things evolve, and the biggest, um, the single biggest thing that could happen that could save Japan here is that inflation does go down, right? So that would be what saves Japan, that they see this period of inflation and it ends up being transitory, just like it was right here, just like it was right here and here, right? And that this time is not different, in that we're going to see Japan head back into deflation very soon. And by the way, in each of these instances, I believe it's safe to say that the Japanese yen was strengthening. So let's put the Japanese um, exchange rate against the US dollar. Let's put that. Yes, right. So this is the US dollar to Japanese interest rate, foreign exchange rate. And every time that Japan experienced a round of deflation, right, that inflation was coming down, that was a big drag um, on on the US dollar to Japanese yen. So the yen was strengthening. Same thing happened here. Same thing happened here. So deflation is very good for the Japanese yen. And right now, with the inflationary policy that they have, it's more likely that you're going to see perhaps inflation stay at these levels, and that that inflation expectations are going to start de-anchoring, and that could lead to a much broader weakening of the Japanese yen. And then you start to get into the real problems um, of a currency debt crisis, where let's go back to the Japanese yen chart. If this really happens, if this breakout really happens, as investors essentially lose confidence in the Japanese yen, if this breakout happens, this would be inflationary for Japan, because it's going to make Japanese goods more attractive. It's going to make people want to go to Japan for holidays and spend in Japan, because it's essentially things are going to be cheap in Japan relative to the rest of the world. And so all of that is going to be inflationary. It's going to stimulate a lot of demand for Japanese goods, Japanese services, Japanese labor. And so that's that's a doom loop, right? That's where the weak currency turns into inflation, and the inflation weakens the currency even further. So that's we're not yet at that stage, but if that happens, that could be where Japan is heading, which is not necessarily the greatest thing. So yeah, I don't know if before we dive into the actual setup here and the actual trading levels on the Japanese yen, if you wanted to jump in here.
Yeah, sure. So, in essentially to summarize what Peter was saying, uh, Japan and their currency situation, they're kind of stuck between a rock and a hard place, and it'll be an interesting case study to see, um, a if they can manage to get out of this without too much damage to their economy, and b what are the outcomes of this as they start to work out. Um, so that's kind of why we're taking that trade. Now, I did see Corbett have a comment here on YCS as a vehicle to play this, and that's exactly what we are doing. So YCS is it's a leveraged bet short on the yen
Yeah.
compared to the US dollar. And Doug, to answer your question with regards to the time cost, um, we're not the time cost really plays into effect if you're just kind of holding that position long term, not looking at it, don't have a stop loss. We're not planning on being in this position for a long time if it doesn't play out. If it starts working for us, then that time cost is completely negligible. Um, but yeah, it's not something that we're overly concerned about with this position. So that's to answer your question there.
Yeah, no, I agree with that. Using leveraged ETFs is not something that you do as an investment, right? But it is something that you can do uh, to to increase your exposure for a certain time period. And at the end of the day, our trading strategy revolves around being involved for a limited amount of time in the stocks or assets or currencies that we trade. We're not looking to hold these for extended periods of time. That's passive investing. We have our recommendations regarding that, but that's not what we do actively on the website. We really have a very active trading approach where we're going to try and time our entry, time our exit to capture the meat of the move that we expect on that particular asset. And so, in regards to a leverage ETF, that's perfect for us because it allows us to increase our exposure, especially on a currency that doesn't have very wild moves, right? The uh, move that we're expecting on the Japanese yen here, first of all, we could already be booking some profits just at this high, right? Already there, that could be an area to book profits on the normal exchange rate. That's just a 4% move. And if we're right about this breakout, let's say we go to 180 before we book some profits. Right, I'm just putting some arbitrary numbers, but this is a potential resistance right here from this 177 level, right? To get to that from where we are, that's roughly a 13% move, which is okay, but we are looking for larger gains than that. And on YCS, which is a leveraged bet, we're going to have a 30, potentially a 30% gain on that trade if it plays out, which is more along the lines of what we're looking for, if we're right, of course. So let's talk about that. Let's talk about the risk reward here. You can see YCS, by the way, is the same chart as the US dollar to Japanese yen chart, right? So we're really making a bet long on the US dollar here against the Japanese yen. And let's come back to the technical chart of the Japanese yen and zoom in a little bit more because what's happening here, and let me put a few moving averages, removed all my moving averages, so I'm gonna have to put them back on. But generally we pay attention to the 100, 150, 200-day moving averages, and then also the 50-day moving average, which are, they're not magical, right? But they give us an idea of what the trend is on our time frame, on the time frame that we're looking at. And our strategy revolves around being long on assets, stocks, currencies that are trending higher. And we want to be timing our entries in a way that we're capturing the resumption of the move up, right? Or if we're shorting, the move down. So when we're shorting, we want to be, of course, going short on stocks or assets or currencies that are trending lower, right? So in this case, it fits what we're looking for because the US dollar to Japanese yen is trending up, and the moving averages have curled up very nicely here, starting in October of 2024. The price is staying very nicely above these moving averages, which is also a constructive development. It means that there's momentum. And we've also seen a breakout here take place above this line right there. So that's also a key component of how we trade, is to try and time the specific entry for it to be timely, right? And so not only do you want to take advantage of the momentum and the trend, but you also want to be timing your entry in a way that allows you to capture the most upside in the shortest amount of time. And this breakout here, we know that, well, if we're right about where the Japanese yen is going, it's going to continue moving higher, and this trend is going to accelerate. If we're wrong, it's going to do this, right? And this breakout is going to fail because there's going to be buying pressure on the Japanese yen, selling pressure on the dollar. That's going to take this bet down, and that's where we get stopped out, right? So again, it goes back to really our key principle, and this is I think information that not a lot of I don't think you can find this anywhere out there, because there's nobody that really trades macro actively. Lots of people talk about macro. Lots of people have an opinion on macro, but ultimately, do they know how to implement it in an actual trading strategy? In 99% of the cases of the people that you see online, no, right? And so this is the system that we've been working on for a long time now, is to how to implement our understanding and our edge in regards to what's happening on the macro side of things, and implement that into a trading strategy that works, and can yield systematic results, right? And so that's where we're at, right? There's a fundamental backdrop for being short on the Japanese yen, and trouble with the Japanese government and their current policies. But that needs to be confirmed by the price action, right? And what we have on the Japanese yen is not only it is a confirmation here. And so in terms of the levels, specific levels that we're looking at, there's this downtrend line right here that defines a stop loss, and this uptrend here that's was tagged very nicely, 1, 2, 3, 4 times. It is a strong uptrend. It looks, you can see the last time it was tagged, the Japanese yen was able to very nicely clear, and lots of buying pressure coming in here. So strong price action, strong behavior, and we would not want to see the Japanese yen come back below this trend line, because that would be again a break of some key structures that we're looking at. And the final level that we're looking at is this one right here, which is the 151.8 level. I believe that's it, right? 151.79. That's a horizontal level, right? And you can see it mainly acted as support right here, as resistance right here. So big level from a resistance standpoint. But we think if the Japanese yen does come back to this level, that there's going to be buying pressure, there's going to be demand here. So we are leaving a little bit more room on this trade. So it's not an excessive room, but it's not a tight stop loss, because because of that hedging aspect, because of the fact that we have those bets that are betting against the US dollar, and that will do very well if this happens, because that would mean that the US dollar is weakening. But ultimately, if as long as it stays above this level, it's in a positive structure. If it starts to break below that, it puts into question our thesis, essentially, on the timeliness, at least, of when the Japanese yen could actually decline in a big way. Yeah, I don't know if you had some things to add here, Nick.
I think that was just a really good summary of kind of our approach. It's trying to blend the macro edge with the technical analysis, because you use the macro information that you have to start building your bias. But unless you have that confirmation with your technicals, you don't necessarily have an active trade setup. Um, that's different when it comes to a passive investing style, and by all means, it's something that you can utilize with respect to the macro for investing. But if you want to be an active trader while also using a lot of macro information as a key backstone or a backstep to your strategy, it's imperative that you have um, technical analysis as essentially the front runner to determine whether or not you have a clean entry, to determine your risk. Because without that, then you just get stuck in these bets wondering, well, hold on, the market should be doing this, but it's not. And the market has a mind of its own, and you can only make the best bets with the best odds of success. And using the technicals to protect yourself and to try and time that's essentially the basis of this strategy. And it's um and yeah, so that's essentially what we're trying to do here by blending our macro thesis with the technicals to go and get a picture for an active trade here.
Yeah, yeah, absolutely. Could not have said that better. I think yes, just pressing on that point. I think if I can show again my screen here on the trades that we take on our website, every single one of them follows this framework, right? So we have an opinion on what's happening on the macro. We have an opinion on how inflation, unemployment, and all of these things fit in, of course, and where the market is going, of course. But it needs to fit into a proper price-oriented strategy that that's going to allow us to limit our risk and calculate our potential reward on each and every single trade that we make. So it's not rocket science, right? And again, that's actually the ironically, it's the part that most people get wrong, and damages the most people in trading. But it's the easiest part to implement, right? The macro stuff and all that, the intermarket, that's something that you can pick up along the way as you're interested in things and interested in how to develop your edge. But in terms of just generating a return on investment in your trading, it's just about the discipline of calculating your risk versus your reward on each and every setup, and that can be price only, right? And while we're absolutely fans of macro and understanding how that fits in, the reality is you can just pay attention to the price and the behavior of the market to generate a profit. And again, this is how these losses are not something that we're looking to hide at all. These are an integral part of our strategy, and they're the reason for why um, we can be successful in the market. It's these losses that are really the most important. Is the fact that we have a 4.7% loss and not a 15 or 20% loss. That's what damages the most people. The gains, yes, of course, managing the profits and managing successful trades is very important as well, and also doubling down on the profits on the successful trades. That's also something that can increase your return substantially. Yeah, just wanted to press on that point one more time. I think we've pretty much covered everything that we've talked about. We wanted to talk about. I, I thank you. I thank everybody for joining this live. It was a great session. Yeah,
Yeah, we appreciate it, guys. Thank you so much for the participation, the great questions, and we look forward to continuing these in the weeks ahead.
yeah, absolutely. Thank you, guys.
Okay, have a good one.